interest on national debt, over $1 trillion. If this continues, the country will become de facto bankrupt.
You don't need to get rid of government debt. You need to understand what it does. The equity of the banking sector being positive, the government going to negative financial equity, but the debt ratio is not. Elon, you've misled us. Where's the crisis? It's not happening. Musk has declared he's going to form a new political party, and the objective of that party is to eliminate both the Republicans and the Democrats, because he believes neither of them will ever address what he sees as the most serious problem, and that is government debt rising and interest payments on debt coming out to wipe out the entire economy. He believes if we don't eliminate government deficits, we're going to have a huge crisis in the future. So Musk is committed to a vision of a better world in which the government always spends no more than it takes back in taxation, and in which government debt is either much, much lower. Let's say it's gone to zero. So what I'm going to do in this video is I'm going to build Musk's ideal world in Ravel and see what happens. I'm going to have banks, depositors, the Fed and the Treasury, and see how the system works from all their points of view. So I bring up the banks table here. Musk hasn't said anything about getting rid of the private financial system. Still going to have banks that issue loans, and they're still going to have depositors who receive those loans, and then we have the net worth of the banking sector, which I'll call bank equity. One essential thing for banks is banks must be in positive equity. Any bank whose assets less than its liabilities is bankrupt. So the banks have to have positive equity. Let's say they start with 10. And that could be 10 million or 10 billion, whichever unit you wish to work with. Let's say depositors have 90 in their accounts. That means that loans have to total 100 to balance the overall system. And this is something which is a critical element of the financial system and a unique aspect of my software Ravel. It's the only program that lets you enforce what's called the fundamental rule of accounting, that assets minus liabilities minus equity equals zero, and then it sees the consequences of that the entire financial system. But I'll start with the banks here. So of course bank loans are going to occur, and a bank creates money by putting money in your bank account. This will be credit dollars per year put into bank accounts of people who are borrowing money from the banks. So that particular line is balanced. Interest on loans, and that's going to be coming out of the accounts of the depositors who've borrowed the money, interest on loans, and that's going to go into bank equity over here. The banks then spend out of their net worth, so minus spend by banks comes out of that account and it goes into the deposit account. So that's looking at the private sector alone. Now we're also going to have the government inside here. So we need to have a government spending, and that's going to increase the amount of money in non-bank private sector. How do we balance it? That spending comes through another asset, the reserves of banks. We're used to talking about reserves as a way that one bank settles its arrangements with another, but the way the reserves are created, as it happens, is by government spending in excess of taxation, which we're not going to have in this model. So I'm going to show spending by the government increases reserves, which is what happens right now, and taxation reduces reserves and also reduces deposit accounts. So it's going to be a minus tax here and a minus tax also on reserves. And I'll enforce the rule when I put the model together that spending is exactly equal to taxation. So no government debt is accumulated, and therefore there's no bonds to be issued, and there's no interest to be paid on bonds either. This is the perfect world. I bring up the depositors table here, and what is an asset for the banking sector is a liability for the private sector and vice versa. So if I check for liabilities which haven't yet been allocated as assets for anybody else, Ravel tells me it's just the amount of money in depositors accounts. So I bring all those operations across. Asset of the banks, the loans, are now a liability of the non-bank public, and I can now tell Ravel to balance the equity here because everything else affects the net worth of the private sector. Let's call this private equity. I know it's got another meaning, but this is the net worth of the non-bank private sector. And then we bring in the government down here as well with the Fed. So bring up their table, and they have the liability of reserves, which being an asset of the banks, they're a liability of the central bank, and they also are the organ with which the Treasury actually banks. So the Treasury has what's known as the Consolidated Revenue Fund at the central bank, and all the transactions we're seeing here pass through that account. So government spending reduces CRF and taxation boosts the CRF, and the overall sum is zero. Here's the Fed's equity, that sums to zero. Complete the full system, bring up the Treasury's table, and it has the asset of the Consolidated Revenue Fund, of course. Has no liabilities in the system yet because we don't have any bonds being issued. So the Treasury equity is over here, and spending reduces the equity of the Treasury and taxation increases it, but the rule that the government must spend no more than it gets back in taxation means that the Treasury equity remains at zero. So having set that model together, I'm now going to bring across all the variables and start building a model of the system. I'm copying the stock and flow variables from there, and I want to copy the stocks here as well. So I'm now going to start building a very simple simulation model using the flowchart mathematics that Ravel employs, and the most obvious one here is that interest on loans is equal to the interest interest rate. So I'm going to create a new parameter called the interest rate here and give that a value of, start at say 5%, and enable me to change the amount during simulations to say maximum of 20, 0 of 1%, and a step size of 1%. So I now multiply the interest rate by loans. I get the amount of money being paid as interest on loans. How does the private sector pay that? Well, I'm going to use the simplest idea that you can find everybody from Milton Friedman at one extreme to Marx at the other, that there's turnover of money. We call it money velocity. Multiply the amount of money in deposit accounts by money velocity, you get a measure of monetary GDP. So take depositors here and have money velocity and give that a value, say, of 2, a maximum of 4, minimum of, say, 1, and a step size of 1.1. You multiply money velocity by the amount of money in deposit accounts and you get GDP. Now, interest payments in by banks mean they have money to spend. We have to say how much they're going to spend. And the basic argument there is that banks spend a certain amount of the money that's in their account every year, but because their banks are quite wealthy, they spend slowly. So we're going to have the turnover rate for banks, and that's going to be a parameter. And because they're quite wealthy, they spend slowly. Let's say they spend 50% of the amount of money in their accounts at any particular point in time, minimum of 10% of that. So multiply the turnover rate by the amount of money in the short-term equity of the banking sector, and that's spending by banks. You can see that number turning up there. Haven't defined credit yet. A simple argument here is to say that banks lend out a certain fraction of GDP every year, or lend relative to GDP. So I have a lend frac here and get that a value initially of 0, so there's no lending, but then banks might say lend equivalent to 20% of GDP maximum minus 20% as paying off debt as a minimum, and then a step size of 1%. So I now multiply the lending frac by GDP. I get credit. And I now need to finally define what the government's doing. So the government will also have a spend frac, the fraction of GDP that it spends every year. I'll give that a value of 0.3 because that's roughly the scale of government spending in the United States, 30% of GDP. Give a maximum, say, of 50%, minimum of, say, 5%, which is where it was roughly during the 19th century, and multiply that by GDP. And I'm going to have spend frac, so multiply those two together. This is the rule that is imposed on the government now. Anything it spends, it must put the same amount of tax in. So that way, spending is exactly identical to taxation, and therefore there's no change in the debt level of the government and no need to pay interest on government debt because there is no government debt. Now let's look at what happens to this economy over time. Let's first of all look at GDP, and let's look at the net worth of all these entities in here. So I've got the Treasury equity, I've got the private non-bank sector's equity, I have the equity of the banks, and I have the equity of the Fed. 4 entities in the system, so there's 4 equity calculation. Let's just see what happens. I'll bring a graph down, attach it to GDP. That's a flow of dollars per year in that case. This is the dollars that are the worth of each of the entities in the system. So let's look at private equity and banks equity, and then I'll add the Treasury and the Fed together to have government equity. Let's just make that. So I'm going to add those two together, type a plus key there, and that's going to be Gov equity. So now we have the net worth of each of those entities in the system. Hit the simulate button and see what happens. And we've got constant GDP. The equity of the private sector is negative, minus 10. The equity of the banks is positive, plus 10. There's no change to that over time. Let's just label these so you can see them more clearly. This system has a problem, and that is that no matter what you do, private non-bank sector remains in negative financial equity because the banks must remain in positive. So let's have now an increase in lending, so the lending fraction goes up, and you get a rising GDP coming out of that. But what you get is falling net worth of the private sector. The more GDP grows, the more the net financial equity position of the private non-bank system is negative. No one enjoys being in negative equity. This is part of the driving force for the whole panic about government debt in the first place. Nobody enjoys it. What can the private sector do in this situation? Well, what it can do, and what it has done in the past, is it borrows money from banks and goes and buys non-financial assets. Now there's a catch. Where's the monetary demand coming from to buy houses and buy shares? At least 70% and often 100% of the money that's used to buy a house is borrowed. So the monetary demand for new housing is the change in the level of household debt. And that's just an assertion at the moment. Let's check the data and see what it gives us. So this is data on everybody's favourite bubble, the subprime bubble in America. But I'm going right back to 1968, as you can see here. I'm looking here at the level of household debt on one axis. It's the left-hand axis, and that's graphed in terms of the black line. That's household debt as a percentage of GDP, which rose from of the order of 45% back in the 1950s to way up here, over almost 100% of GDP. That's acceleration. So the thing which sustains rising house prices is constant or rising acceleration. What we see is this tendency for the non-bank private sector to borrow money from the banks to gamble on rising asset prices, which is done in response to being a negative financial equity, inevitably leads to a boom and a bust. And we see that in the stock market as well. Let's take a look at the stock market, where margin debt is now the important level of debt. And you can see the explosion in margin debt in the 1920s. It went from about 1% of GDP at the beginning of the 20s to 9% at the peak, and then it plunged down there. And then you get the period of very low margin debt and then rising margin debt again now. This down here is looking at change in margin debt in percentage terms and change in the cyclically adjusted price to earnings ratio, and you get a huge correlation there. That's 1,000 data points or 1,200 data points. So it's a massive correlation. Again, the mainstream completely ignores this. So this is the consequence of having a purely private sector. There was a serious recession in the 19th century every 5 or 10 years. And some of those recessions were as serious as the Great Depression, the 1873 downturn, Panic of 1837, and so on. It had exactly the characteristics that Musk wishes to achieve. The government spent exactly what it got back in taxation, and it had zero debt. Actually, it's to a problem for the private non-bank sector that it ends up in negative financial equity. Can we fix it so that the private sector doesn't go into negative financial equity? Well, yes, we can. So I'm now going to delete this link between spending and taxation and say that as well as having a spend frac, there's a tax frac, taxation. Of course, we can have a gap between the two now. Spending can be greater than taxation. So if I subtract spending from taxation, I get the deficit. Now, I'm not going to include any bond sales at the moment. Let's just see what happens if this occurs, what actually occurs in the system. Let's just reset it now and go back to the starting position, and I'm going to start lending at 3% of GDP. Credit's often much larger than that. Have the government spending and taxation being the same level, and you end up in the same situation that the private sector is necessarily in negative equity and it's getting worse. What if the government increases its spending fraction? Look what happens to private equity. It rises. So in this situation, government going into negative equity enables the private non-bank sector to be in positive equity as well as the banks, and that removes the panic factor that often drives the private sector into borrowing money from banks and gambling on rising asset prices. Does it have any weaknesses, this system? Let's take a look at it. Well, what it does do, and you can see this here, is that the Treasury's account at the central bank goes into overdraft. The government has to sell bonds to the central bank equivalent to the deficit it's running. So we're going to have bond sale from the Treasury to the Fed, and that is going to increase the asset of the Treasury. So the sale of bonds by the Treasury to the Fed gives the Fed an asset, and it also makes sure that this sum remains at zero. So we now include that in the system, and now I want to add that additional flow inside here. So take a copy of the flow variables here, and the rule is therefore that the bond sales by the Treasury to the central bank are equal to the deficit. So we now run this system and see what happens. What's going on here? No change in the overall pattern there. The government goes into negative equity, creating positive equity for the non-bank sector. So any other problems elsewhere? Well, let's take a look at it. And what we see is that the banks are now ending up with these assets called reserves, which they earn no income on. And if we keep on going for long enough, if I increase the scale of the government deficit, for example, get to what level we're at now, then you get a massive level of assets for the banking sector here, which earn no interest for the banking sector. The banking sector doesn't like having debt assets, so let's say they persuade the government, rather than selling the bonds from the Treasury to the central bank, let's say they persuade the Treasury to sell the bonds directly to them instead. So we now have to bring that into the system. I'm just going to include the fact that the Treasury now has a liability of those bonds, so that element is there as well. But we want to have bond sales to banks here. So there's going to be another liability, which are bonds owned by the banks. And so that's going to be increased by, so we're going to have bond sale Treasury to banks, and those bond sales are going to increase the value of those bonds are going to go to the Treasury account. So that's now going to mean that the Treasury account can remain at the level of zero. You don't go into overdraft anymore. So let's just pick up the tables here. So we now have bond sales by the Fed. That transfers money from the reserve accounts. So what now happens is these sale of bonds by the Treasury to the banks, drain those excess reserves that turn up in the system. That's not going to be enough for the banks, as well as getting the bonds which they can trade. Why not pay them some interest on it? So we now have interest paid to banks. That's going to be funds that come out of the Treasury's account at the central bank and goes into reserves. And that ends up being income for the banking sector. So we now come back to the banks table and now fix these elements up. So we now have another asset that is owned by the banking sector, bonds owned by the banks. That now brings that transfer across. And the interest payments boost the amount of money that the banks are earning. So they're getting interest on those bonds as well. And now let's look at this system. I've still got to fix up one element here in the Treasury table. So I'll bring this up. And that's interest to bonds on banks. That also affects the equity of the Treasury. So spending by the government reduces the financial net worth of the Treasury, taxation increases it, and interest on bonds reduces the financial equity of the Treasury. But that boosts the equity of the private banks as well. So let's now run this system and see what happens. And we get the outcome we want. We want the private sector, the private non-bank sector to be in positive equity. The banks are also in positive equity, and that's precisely matched by the negative equity of the government sector. That's looking better. This is the same system we live in right now. And according to Elon Musk, this system is going to have a crisis. So let's check that. So I've got interest paid on bonds to banks, and that's now another element we need to include to complete the whole system. So interest on bonds to banks, that's going to be equal to the interest rate, which I'll take a copy of up here, times the value of bonds that are owned by the banks. So I'll take that I'll bring across the browser to bring that in. So I've now got bonds that are owned by the banks, and I multiply that by the interest rate. I now get interest payments to banks by the government, and the rule that the government has to operate by, as we know at the moment, is that the government is required to issue bonds that are also equal to the deficit plus the interest on existing government debt. So we then add those two together and then delete this link. We now have a higher level of bond sales. Now, according to Elon Musk, we have to get out of this system, because this is going to cause a crisis. So let's look at the crisis. I'm going to take interest being paid to banks and the deficit itself and take a look at those as a percentage of GDP and see what happens according to Elon. This causes an absolute explosion in the level of government debt. Crisis is inevitable. Deficit's going to be a huge percentage. The government debt's going to be a huge percentage of GDP. Everything's going to be terrible. And that's why we need to change the system. So let's look at interest payments as a percentage of GDP by the government. So I want to divide interest on bonds paid to banks by GDP and put that through a percentage operator to express it in terms of percent of GDP. So this is int paid by the government as a percentage of GDP, and we're going to look at debt as a percentage of GDP as well. So I divide the bonds that are owned by the banks, which is the measure of outstanding government debt in this system, by the GDP, and then divide that by. So now we have government, and this is debt as a percentage of GDP. And now, according to Elon, this is going to be catastrophic. We're going to see rising interest payments and rising levels of government debt as well, and that's why we have to change the system to the one he thinks is perfect that I explained a short while ago. Let's just graph these two. So let's look at government debt as a percentage of GDP and interest payments as a percentage of GDP. And in this system, we have this government spending being 35% of GDP and taxation 5%. That's pretty close to the level we have right now. So what I've got now is bond sales to banks. I've now no longer got the government selling bonds to the Treasury, I've got them selling bonds to the banks. So let's see what happens in this system. According to Elon Musk, this is just absolutely set for catastrophe. We have to have an exploding level of government debt to GDP. Everything's going to go to hell in a handbasket. Run the system, and now let's see what's happening overall. So we have the equity of the private sector being positive, the equity of the banking sector being positive, the government going to negative financial equity, but the debt ratio is not. Elon, you've misled us. Where's the crisis? It's not happening. The reason it's not happening is you don't understand the monetary system, and you're trying to redesign it to get rid of a problem that doesn't exist. For God's sake, learn about how the banking system actually operates, and you'll see you've got exactly the same false fear here. We don't need to get rid of government debt. We need to get rid of people thinking government debt is a problem.
If you're like many other truth seekers and want to learn 50 years of real economics from me in only 7 weeks, you'll love my new 7-week Rebel Economist Challenge as well. To apply, go to stevekeen.com. If you qualify, you can attend my lectures, ask me questions personally every week, and make friends with a great group of like-minded people. So again, like many others, go to stevekeen.com to apply as well for the 7-week Rebel Economist Challenge. Good luck.